Hi guys, Dave Welliver here for FullPocket. And really quickly, let's talk about how credit cards work. Credit cards we carry around in our pocket, most of us every day. Or perhaps you're carrying around debit cards and you're thinking about getting a credit card, but we never stop to think how they actually work, what makes them different from paying with a debit card or even cash. So here's a really quick primer. All right, so you've got a couple different types of cards that you might have in your pocket at any given time. You might have a debit card, you might have a credit card. Well, debit cards, as we know, are pretty straightforward. You've got a checking account over here at your bank, and you've got some money in there, and you buy something at a store. Let's say you're buying a coffee, and the money for that coffee comes straight out of your bank account. The debit card talks to a network in the middle of processor, basically, the MasterCard and Visa network. And there's a whole bunch of steps in between, but basically the store runs your card, the processor checks with your bank to make sure you have the money. They then transfer the money from your bank to the store, and they take a few cents, small percentage of the purchase for running that transaction for you. The result is you spend money that you actually have in your bank. Now, let's look at credit cards, which are going to work a little bit differently than the debit card. So you're going to buy the same coffee, but there's a few more things involved. So with a credit card, the same thing's going to happen. You are going to go to a store, you're going to buy your cup of coffee, and the store is going to run your card and it's going to go through a network like Visa or MasterCard, and they're going to take a percentage of that purchase, although they're going to take a little bit more than they would with the debit card. Just kind of the rules of the road here. Now, where's that money come from? Instead of coming directly out of your bank account, it's going to come from a bigger bank. Draw some big city bank. And this is the credit card bank. So the credit card bank is actually going to front the money and pay the store. So they pay the store. And what happens? So you have now basically borrowed the cost of that cup of coffee from the big credit card bank. And once a month, you're going to get a bill. And that bill is going to have that cup of coffee on there. So you spent $2 on a cup of coffee and everything else. Maybe you bought a tank of gas for $30 and some groceries for $55. And so at the end of the month, you're going to have a bill of $87. Here's where things get interesting with a credit card, right? A credit card is a short-term loan. It's actually a short-term revolving line of credit. They give you a credit limit. Let's say it's $10,000. You can spend up to $10,000 on that credit card at any one time, regardless of whether you have that money in your bank or not, okay? At the end of the month, they give you this bill with everything you spent for the month. If you pay the entire amount of all the purchases you spent that month, this example, $87, that's great. That's it. The credit card bank gets their money. The store got their money. You paid the money out of your account to the credit card bank. Everybody's happy. And it didn't cost anything, okay? You aren't going to pay any interest on those charges because you paid them off at the end of the month. This is what's known as the grace period, right? Credit cards give you a grace period in which you can repay charges without incurring any finance charges or interest. And so that's what makes credit cards so convenient. And on top of that grace period, being able to use them for a very short-term interest-free loan, they'll actually pay you interest, or not interest, but rewards as a percentage back. So where does that money come from? Well, it does come from people that are paying interest on credit cards, and we'll get to that in 1 minute. But remember that this network in the middle, whether it's Visa or MasterCard or Discover or Amex, okay, that network has negotiations with all the stores that accept those credit cards that they get a percentage of every dollar spent at that merchant. And that could be sometimes up to 3 or 4%. It depends on a lot of factors based on how much volume that merchant is doing, what they sell, how often someone refunds or disputes a transaction. But anyway, the credit card companies get fees every time you use a card. Same thing with debit cards, but the fees are higher with credit cards. These are known as interchange fees, and they're a big part of how credit card banks make money. This is also where rewards come from, right? Basically, credit card rewards are a way to incentivize you, the customer, to use Bank A's credit card instead of Bank B's credit card. And they do that by offering richer and richer rewards in the form of cashback or travel points. And these rewards essentially come out of the interchange fees. They're splitting that profit with you. Now, here's the thing. We talk about avoiding credit cards because you don't want to go into debt, and you don't. But the price of those interchange fees that the merchant stores have to pay is baked into the price. And so if you're paying cash and the guy next to you is paying with a credit card for the exact same thing, and he's getting 2% back on his credit card, he's getting a 2% discount essentially on the same product. And this is what's frustrating is, the people who are trying to avoid debt, doing the right thing, or the people who can't even get a credit card in the first place because of your financial situation, you're essentially paying more to the tune of hundreds, if not a couple $1,000s every year for the things you buy, compared to someone who uses a credit card and gets those rewards back. Just food for thought. Okay, guys, let's continue with, we know what happens if you use your credit card for monthly purchases and you pay it all off at the end of the month within the grace period. You don't pay any interest. What happens, however, if you don't pay all of it off? Okay, and this is where credit cards can be dangerous and they get their bad rap. Because on a credit card bill, you have your total balance, that's the $87 that you spent last month, right? But you don't have to pay all $87. The credit card bank will be happy to give you a minimum payment of, in this case, let's say $15. That's all you got to pay. If you don't pay that, you're going to get late fees, you are going to ruin your credit score, and eventually they're going to cancel your credit card. So you've got to pay that by the due date. But if you only pay $15, you've got $72 left on your credit card that you spent but haven't repaid yet. Well, this is when interest kicks in, okay? And so every credit card has what's known as an APR, or annual percentage rate, and they're quite high compared to other types of debt. It's not uncommon for a credit card to have a 20%, maybe even 25% interest rate. And what's going to happen is they are going to start charging from the day after your due date that 20% interest on the $72 you didn't pay. And so the next month you're going to get a bill and there's going to be a new line on it. You're going to have your new charges, say you spent $50. You're going to have the $72 that you haven't paid, and then you're going to see a charge of finance charges. And these finance charges are the interest. And that's going to be on $72, it's not going to be a lot, it's going to be a few dollars because it's 20% divided by 365 days in the year times however many days there are in the month. It's an annual percentage rate, but they actually compute it daily. And so you're going to owe a sliver of that annual 20% on the $72. As long as you pay it off soon, it's a few dollars interest. It's actually less expensive than, let's say, you used a debit card and overdrew your account and get a $40 overdraft charge. A few dollars here and there on a balance of less than $100 or a few $100s, that's not so bad. It's actually pretty reasonable if you needed to use the credit card in the short term because you were having a hard time coming up with the cash. What happens is this compounds, right? So you only pay the minimum payment and then interest adds on that. You've got another month's balance, interest adds on that. Suddenly that couple of dollars in interest is $20 a month in interest and then $40 a month in interest. And that's where people get stuck using credit cards because each month they don't have enough to pay the bill. They are incurring more, adding to that balance that's unpaid, and the interest grows and grows. That, in a nutshell, is how credit cards work. How they can work for consumers who just want to use them to make daily purchases and then repay the balance every month. Not going to pay a dime in interest, and they'll actually get some money back in the form of credit card rewards. But also how it works if you need to carry that balance or you can't pay the balance in full at the end of the month and interest starts adding up. I hope that's helpful. Check out FullPocket for more simple, straightforward financial advice. Until next time, I'm David Welliver.